Hello, everybody. Welcome to OIC's webinar series. Today, we're happy to bring you a rebroadcast of a recent live presentation. I hope you enjoy it and make sure to stick around afterward for a live Q&A session immediately following today's webinar. All right, I appreciate everyone sticking around and or joining us for this third session. One of the things that I like to talk about when I talk about options is what I call the aha moment. The aha moment happens for everyone in different ways at different times. My aha moment happened to be in the members lounge of the CBOE exchange, where Lanny Brooks, my teacher, was always teaching me options every single day. And my job as his clerk in 1999 was to buy him a Caesar salad and 3 forks, because we sat and talked about options during his lunch break in the members lounge. Lanny was a pretty amped up guy. And every time that he would jab into his salad as he taught me put call parity, every once in a while he'd break a fork and I would have to hand him one of his other forks. Halfway through, about 3 months in, I realized when Lanny was talking to me about options, why calls and their corresponding puts had a relationship, the put-call parity relationship. That was my aha moment. Everyone has an aha moment that is different for them because the concepts of optionality kind of reach everyone in different ways. The reason I give you this background is because this presentation was set up as a way to teach people about option Greeks without using math. That's why it's called the Mathless Greeks. It came about because I was talking to my boss, who said, wouldn't it be great if we could teach people how Greeks work without actually using math? And I said, you know what? I think I can probably do that. Let's give it a go. So hence the Mathless Greeks was born. That is what we're going to do today. This is the disclaimer. You've seen it many times. These are the trademarks. You've also seen them many times. You'll see them used throughout the presentation today. And at OIC, you should know, I hope by now, after sitting here and listening to us talk for a while, that we are the educational arm inside the Options Clearing Corporation. We're a non-for-profit entity, and our entire job is to basically teach people how options work. So let's get right to it. Options volume for the last 23 years. I use this at the beginning of every presentation that I give. If you look at this in, what was it, 2008? That's less than 4 billion contracts of cleared volume. I was standing in the SPX pit at the end of the year, and I looked up and saw the number go across as the cleared volume number. It was probably the most volatile thing I had ever seen for the last 12 months. That number, 3.7 billion contracts, was the most volume I had ever seen. And if you look at where we are now, over here somewhere, we're talking about 11.2 billion contracts cleared. What this tells me from an educator's perspective is that there are more people involved, and they're more involved on a daily basis, trading more every single day. And that makes what we do even more vital to the way that this marketplace functions. It's important that you understand how the options work before you start pressing buttons. Let's talk about what we're going to reach today. I'm going to talk about the full Greeks dashboard as the way that you can kind of holistically think about risk. We're going to talk about delta specifically, then delta through metaphor with no math. I promise there will be no math. Gamma specifically, gamma through metaphor. Again, there will be no math. And then we'll talk about theta and theta through metaphor as well. Again, no math. Let's dive into, and then we'll have some Q&A at the end, hopefully. Let's talk about the Option Greeks dashboard. The way I think about Greeks and the way that I try to transmit this is when you hear the term delta, I want you to think about speed. I want you to think about this is a measure of how fast this option is moving. Because that's essentially what it is. It's expressed as a decimal, but it's really just telling you what percentage of the $1 move in the stock that you just saw is this option going to replicate with how you have it currently modeled. So if it's expressed as a 50 delta, it'll be 0.50. You can theoretically expect that option to move 50 cents for every dollar move that the underlying moves. When you hear, oh, that's interesting. When you hear gamma, I want you to think acceleration. Gamma is a measure of how much your delta is going to move. Delta is a measure of price movement. Gamma is a measure of delta. Many times when you talk to people about options who have traded it for a long time, they will tell you that gamma is actually a second derivative. The reason why they refer to it as a second derivative is because it is a measure of another Greek. It's a Greek that measures the change of another Greek, which is something that people refer to as second derivatives. There's a whole list of second and third derivatives that are all very interesting. We're not going to get into those today. They have great names like Vama and Vama and Volga and Charm. They're fantastic. If you want to take a look at those, you should take a look at them. They are ways that you can measure other Greeks. They're Greeks that measure other Greeks. Theta, when you hear the word theta, I want you to think decay. Theta is a measure of how much an option is going to change in value for every 24-hour period of time. So if we are at 3 p.m. on a Wednesday and we fast forward our clock 24 hours to 3 p.m. on that Thursday, the next day, if your model is telling you that this option has 10 cents of theta, you can expect that that option is going to be worth 10 cents less at 3 p.m. on the next day. Now that's barring any other changes in the optionality, meaning implied volatility or the stock moving or the stock announcing a dividend that they didn't have before, things of that nature. If everything else stays constant and you fast forward 24 hours, theta is going to tell you how much that option should be worth the next day or how much less it should be worth the next day. So the way I think about the Greeks when I think about them as a dashboard is the way to holistically look at your risk without having to look at every single option in your portfolio. If you look at aggregate Greeks, you can have 10,000 options in a portfolio, and it's going to tell you your Greek dashboard across the top, your delta, your gamma, your theta, your vega, all of those things are going to be an aggregate of what your position looks like relative to movement in parts of the curve. So in this way, and I write this specifically because I think it's an important analogy, you don't need to open the hood of your car to know whether or not it's running. You don't need to stick your head out when you're going down the freeway to figure out how fast you're going. The speedometer does that for you, right? There's a light in your car that tells you that it's on, or at least you feel it actually vibrating when it's, unless you drive an electric car, and then maybe you can look at your phone to tell whether or not your car's on. But this is the way that I think about this specifically, because I think it's a good analog to how this mind frame can be used to think about options. So let's talk about delta specifically. I'm going to give you the technical definition of delta, and then we're going to talk about it through metaphor. Delta is an option value's sensitivity to stock price. Like I said before, it's expressed as a delta, it's expressed as a decimal, and it's going to tell you how much your option should theoretically move for every dollar that the underlying moves. It is the expected change in an option's price up or down for every $1 move in the underlying. If you look at any option textbook, that's what it's going to say next to delta. Now, delta can be kind of subsetted into three big buckets. Deep in the money options, which approach the higher bound, the upper bound of delta. One option can only have up to 100 deltas. Because if you think about delta as a percentage change of that underlying $1 move, you can't have one option that's going to move more than 100% of the underlying move. So deep in the money options tend toward the 100 bound, the upper bound. At the money options, which are the options that are around where the stock is trading, generally have deltas of around 50. Again, this is expressed as a decimal, 0.50 or 1.00 for the 100 delta. And then the third bucket are these far out of the money options. These are options that are out of the money. They might be 3, 4, 5, 6 standard deviations away. They are going to tend toward the zero bound of delta. That's kind of how you can think about the three buckets of delta. And it's one way to think about the buckets of delta. But this is kind of how I subset it in my mind. Let's talk about delta through metaphor. We've covered this a little bit. I want you to imagine delta as like a speedometer for your options portfolio. When you look at an option, so you can look at this as an options portfolio. You can also look at it as an individual option. When you're looking at an individual option, just like the car speedometer tells you how fast you're going, delta is going to tell you essentially how fast that option is going. How much is that option going to move when the underlying moves? So if you think about it in that way, just like your car speed can change, the delta of the option can change too. These are not things that are set in stone. Many times when we're talking to people on the investor education desk, they're somewhat surprised that the delta of an option can actually change, as if the delta of that option when you traded it is going to be the delta of that option forever. And that is not the case. I'm here to tell you that is not the case. Delta can move. It is dynamic just like anything else. But just like movement in a car going 100 miles an hour reacts differently than a car going 10 miles an hour, right? If you're going along and you're going 100 miles an hour and you turn the wheel, your car is going to react badly, right? If you're going 10 miles an hour and you turn the wheel the same amount, you're just pulling into a parking spot, right? It's not that big of a deal. Delta's the same way. Delta is a measure of how much that option is going to move when the underlying moves a buck. So keep that in mind. A 100 delta option is very different than a 10 delta option in that regard. Gamma. Gamma, like I said, is a theoretical second derivative. It is a Greek that measures a Greek. When I tell people that, oftentimes their eyes completely glaze over, and many of them fall asleep immediately. I'm not here to teach a math class. I'm here to teach you how gamma works and how you can think about it. So let's start with the definition itself. I'm going to do the exact same thing I did for delta. Gamma is delta's sensitivity to stock price. Keep in mind, when I'm talking about gamma, I'm talking about how much your delta is going to move. When I talk about delta, I'm talking about how much the price of the option is going to move. So take a little bit of a step back and think about what this means for actual prices of options. Because when things move, when underlyings move up and down, the way that they actually acquire or de-acquire value is actually through the process of the gamma affecting change in the delta of the option. So when we're talking about gamma, this is the actual definition that you're going to find in any textbook. The anticipated change in the delta value for a $1 move in the underlying security. It again, if we talk about it with all other pricing factors remaining constant, gamma of that option is kind of a snapshot of how much potential energy that option has at that moment in time. This also is dynamic. It can move just like delta does, and it actually is the driving force behind the dynamism of delta. It's expressed in decimal form just like delta is, and many people think about it as an adjustment to delta. I personally think about it as potential energy. That's what I think about gamma as. When I'm either buying or selling options, I think about the gamma of those options as their ability to change, to transform into something that they weren't before. So it is the ability for an option that starts in the money to become an at the money option or an out of the money option, or it's the ability of the out of the money option to become an in the money option through the change in delta. Only options have gamma. When I say this, many times if I'm talking inside a room full of people who are bond investors, they will disagree with me because bonds have what people call convexity. Convexity acts an awful lot like gamma, but it's not really gamma. Convexity is something that is, it's the change in a bond as it moves up and down. So it has many of the same qualities of this, but it's not exactly the same. Only options have gamma. Let's think about gamma as a metaphor instead of using a bunch of math. Like I said before, I want you to think about it as like potential energy, potential change within the option. Gamma measures how quickly the delta of your option is going to change. And when gamma is high, an option's delta can accelerate or decelerate very quickly relative to that same $1 move in underlying. This phenomenon is on display constantly in our marketplace now because of the move to shorter dated options. People trade shorter dated options now more than ever because there is more of a cadence of expirations. Many times in index options, you'll see that there are expirations that happen daily. You've heard the term zero DTE options. That's what this is talking about. Zero DTE options have exceptionally high levels of gamma and have very low levels of vega, what Emily talked about. Vega is commensurate with time to the back of the curve. As you move back in time, adding duration to options, they acquire more vega. As you move forward in the curve, they acquire more more gamma, because they are so much more sensitive to underlying movement. High gamma options, like I was talking about, zero DTE options, perfect example of high gamma options. These are options that are expiring potentially today or tomorrow or the next day. As you get closer to expiration, especially with at-the-money options, their gamma becomes exponential. You can think of different gamma profiles of options like different types of cars. High gamma options you can think about as like race cars, right? Why? They change direction very quickly, right? If you're an F1 fan and you watch the Mercedes-Benz car and you watch it go around the track, the most amazing part about it is that it takes those curves at like 110 miles an hour, right? Because it has the potential to hug the road and change direction very quickly. That is how high gamma options work. They change the direction of your portfolio very quickly by affecting change on delta. They change the delta of your portfolio very quickly. Sports cars have the potential to change direction quickly or accelerate or decelerate rapidly. These are high gamma options. Conversely, low gamma options. If a gamma that is high has high potential to change, guess what? A gamma that is low has low potential to change. When we're dealing with options in the back of the curve, in the back of the duration curve, like I said, they acquire more vega, but they have less gamma. That means they're less sensitive to underlying movement, but they're more sensitive to implied volatility movement. Now, I'm not going to touch on vega during this because that gets into a whole nother idea of how we want to think about options. But when you're talking about options in the back of the curve, they're going to have really high vega, very low gamma. That's what this is all about. Large trucks require significant force to accelerate or decelerate. If you're thinking about an option in the back of the curve, movement in the underlying is not going to move that option quite as much per every $1 move because the gamma is lower. Because it's less sensitive to underlying movement, it's more sensitive to vega. It's more sensitive to implied vol. It has more vega in the back of the curve. It has more gamma in the front of the curve. Theta. Theta is decay, right? I said at the beginning, what I want you to think of when you hear theta is decay. I want you to think about time. Here's the technical definition. Theta is an option value's sensitivity to time. Now again, we're back at theta measuring price of the option, right? Delta measured how much it should change in price. Gamma measured how much the delta should move. Now we're back at price. Theta should measure how much the option's price should move in a 24-hour time period. It's the expected time decay in option value with the passage of 1 day. It's expressed in decimal form. This would be 8 cents of theta. So if we were trading an option that had a theoretical value of $3, and it had 8 cents of theta, and absolutely nothing changed, and we fast forwarded our clock to tomorrow at the same exact time, we could expect that option on our model to be worth $2.92. That's if nothing else changes. That's theta, or theoretical theta. Here's an important distinction. Decay is per calendar day. Theta doesn't care if it's the weekend. Theta doesn't care if you're in Turks and Caicos. Theta doesn't care if they close the exchange today. Theta doesn't care if it's Thanksgiving. Theta is per calendar day. Now, it's important to think about this because theta is not guaranteed. It is a theoretical measure of how much the actual option should theoretically move. There are lots of different things at work in the actual landscape that can affect change in theta that make it less likely to happen, but this is a measure of theoretical movement. It represents a cash amount per option. So that 8 cents of theta, remember what I said? The option that was worth $3 might be worth $2.92 the next day. That's what I mean when I'm talking about cash per option. And this is all other pricing factors remaining constant. Calls and puts both have negative theta amounts. They also both have the same theta amounts if they're on the same strike. The 50 call and the 50 put have the same theta amount. Why? Because the actual put value in the 50 put is actually inside the 50 call also. Don't forget that. That's how put-call parity works. Otherwise, there would be an arbitrage between those two things. So those two options are actually decaying. As long as they're on the same strike, they're decaying at the same rate. All right, theta through metaphor. Theta is the theoretical decay. I want you to think about it like sand going through an hourglass, right? We have a certain amount of premium that's in an option, and as each day passes, there is less and less and less of that premium in it. Why? Because the premium starts out on the top, which is in the option, and it comes down to the bottom, which is outside of the option. Theta is sand in the hourglass, and at any given moment, there is less sand up top than there is in the bottom. That is the transference of value from your option to time. That is time taking option value away. This is an important part of theta. Unlike the hourglass, theta is not linear. Lots of people ask, what is the theta of my option? And my answer to that is always, you have to tell me based on what your model says, because there's lots of different ways to model theta and think about it, and lots of different ways to express it. But the one thing that I know is that everyone's option model holds this to be true, that theta is not linear. As you get closer to expiration, just like gamma accelerates and becomes exponential, guess what else accelerates and becomes exponential? Theta. I want you to think about it this way. If you think about an option that has 100 days in it, and you take 1 day of value out of it, how much of the percentage of days are you taking out of it? Now, I want you to think about an option that has 3 days in it, and you take 1 day of theta out of it. You go forward 1 day. Now, how much of a percentage of that days are you taking out of it? It's a much greater amount in percentage terms. That percentage is going to be commensurate with the amount of theta. That's why as you get closer to expiration, the theta does this, just like the gamma does. Hello, everyone. I think that the actual presentation got cut a little bit short, but what I was talking about at the end of that was basically how theta accelerates toward the end of the options life cycle. So as you get closer and closer to expiration, that theta starts to become exponential because of the fact that you're getting closer to expiration, and thus there is less time left in that options lifetime. It actually accelerates because of the fact that as you get closer, a larger percentage of the options value is having to come out by the end of its life cycle. And so that's why theta looks the way that it does. That's why that function has curvature to it. A lot of people have a hard time understanding why that curvature looks that way, but that's the reason why it does look that way. The interesting part about this is that I get to answer questions live after I essentially watched myself do a presentation that I did in Florida 2 months ago. It's kind of interesting. Some of the questions that have come in already, I thought I would answer. I've typed answers to those questions and sent them out, but I thought they might be instructive to the entire audience as we go along to actually rehash some of those questions. If you have questions, make sure to put them in the actual chat box because hopefully I'll be able to get to your question and actually answer it live, and you'll get to hear me talk about whatever you want me to talk about. That's kind of part of how this is designed to be interactive. So let's talk about some of the questions that have been asked already. One of the questions that got asked at the beginning was, how does delta interact with theta if you're selling a put or a call? I'll answer that question in two parts. The first one is, let's say, how does delta interact with theta? The important thing to take away from this is that delta and theta are kind of two separate functions, and they're definitely two separate metrics as far as how you think about them relative to options. Delta is the measure of how much your options value should move relative to every $1 move in the underlying. And theta is the measure of how much your options price should actually decay over a 24-hour period of time. Delta and theta aren't necessarily tied together in any real discernible way that I can just say this is how they actually interact. There are moments where they will interact and you'll see them interact with each other, but I can't give you some sort of function as to how they interact with each other necessarily, because they're not really tied to each other. They're kind of independent metrics that exist, and they're telling you different things about the option. One of them is telling you how much it should move as a function of time, which is theta. One of them is telling you how much the option should move in price terms as a function of underlying price movement. So they're separate and kind of parallel functions that you shouldn't really try to think about together. All right, looks like we're getting some. Looks like we're getting lots of questions now. Boom. Okay. What is arbitrage? Ed Kitchen asks, what is arbitrage? Arbitrage is essentially, and I mentioned this in a couple of places during the actual presentation. I want you to think about arbitrage like this. Arbitrage is, for instance, buying the component parts of something, putting it together, and then selling it for more than what you bought the component parts for. Or the opposite, selling the thing and then going and buying the component parts to put it together. In relation to the options market, arbitrage is used as a way to talk about the fact that you can kind of put together option strategies in ways that allow you to buy the component parts and then package them up and sell them in some other way. So for instance, if you're talking about a call spread, like a 20-30 call spread, if you were buying it, you'd be buying the 20s and selling the 30s. Well, you can actually create that and trade it as a price, but then you can go and actually buy the 20s and sell the 30s in two separate prices and then package it up as a spread and trade it. In that case, if you were to have bought the call spread outright for $3 and then sold it to someone else through selling the 20s and buying the 30s, you could say that you had created a call spread arbitrage because you bought the component pieces and then you turned around and sold it to someone outside of that same actual function. So, Ed, I hope I answered your question there. Great presentation and breakdown. Thank you, Greg, for that. I appreciate that. How would you characterize Vega as a metaphor? This is an excellent question and one that I have been thinking about for a while because someone asked me to do Vega and Rho as metaphor, and I haven't come up with a good one yet, Bashi. So if you do have an idea about it, let me know. I'll be working on that in the next year. Keep your eyes open for that because I think I'm going to do the Mathless Greeks part 2, but I don't actually have a great answer for that question yet. What is scalping gamma? Scalping gamma is actually the act of buying or selling stock against a options position as the delta increases or decreases. I want you to think about it this way. If you buy a call, for instance, and it has a 50 delta, and you want to be delta neutral, you might sell 50 shares of stock against that call. In that way, you would be what we call delta neutral. If you are delta neutral, your overall delta is going to show you as 0 because you have a long 50 delta from the call and you have short 50 shares of stock against it. Positive 50, negative 50, that's out to 0. Let's say you walk in the next day and the stock is up 3 standard deviations. And the delta of the option that you bought yesterday, which was a 50 and ended the day at a 50, is now a 75. In that situation, A, you're not delta neutral anymore, and B, if you want to be delta neutral, you need to do something. Because your call delta actually exceeds the amount of stock that you hold against it. In this case, your portfolio is going to tell you you're long 25 deltas. The reason why is because the call that you're long is worth 75 deltas, and you still only have 50 deltas of stock against it. And so what you might do is sell 25 deltas of stock. You might sell 25 more shares. Now what you have is a call that's long 75 deltas, and you have 75 shares of stock against it. Let's say you close that day, and it's all well and good. You're delta neutral again. Now you have one call that's worth 75 deltas, and you have 75 shares of stock against it the opposite direction. You're short those. Now let's say you walk in the next day, and the stock is down 2 standard deviations. And the delta that used to say 75 now says 50 again. Guess what? Your stock position hasn't changed. You're still short 75 shares of stock. What is your resultant delta going to be now? Well, your position is going to tell you you're actually short 25 deltas. Why is that? The reason why is because you have a call that's worth 50 deltas and you're short 75 shares of stock against it. You're actually short 25 deltas. What do you need to do in order to be delta neutral? 25 shares of stock. So now you have a call that's 50 deltas and 50 shares of stock against it. You might say, well, I'm back to square one. Yes, you are back to square one, but what you have just done is created a gamma scalp. Gamma is what moved the delta of the option, but what you did against it is buy or sell stock relative to that to make your position delta neutral. What makes that whole engine move is the actual move in the stock up and then down again, and you being able to sell shares higher and buy shares lower because of the long optionality that comes from the call. But what that is gamma scalping. That's if you're long gamma. If you're short gamma, you would need to do the exact same thing in the opposite direction, which would not be as good in that situation. You would be buying shares higher and selling shares lower. If you want to ask more questions about gamma scalping, I have an entire actual presentation that I did last year on gamma scalping, and you can send us emails at options@theocc.com. I'll talk to you about gamma scalping until the cows come home. But Earl, thank you for that question. I attended late. Is there a recording and how to access it, John? Yes, these are always available on demand after the fact. I think they should be available in a couple of hours or at the very least tomorrow. You can use the same link that you used to access the actual recording that we just did, or that we just, the pre-recorded version of it. you can use the same link that you had in order to access that recording on demand. New to option education, what does at the back of the curve mean? This is a great question. Peter, excellent question. Peter is a quantum physicist, by the way. This is the guy that you want in charge of options theoretical knowledge. Peter, new to options education, when I'm talking about back of the curve versus front of the curve, that is essentially a delineation of duration. So, for instance, if you think of a 30-day option as a 1-month option, and you think of that as kind of the fulcrum of duration as far as front of the curve versus back of the curve, you can think of anything with less than 30 days in it as kind of closer to the front of the curve, and you can think of things as like with more than 30 or 60 or 90 days in them as farther back in the curve. Anytime I talk about the curve like that, front of the curve versus back of the curve, I'm thinking about duration. And duration is a measure of days to expiration that an option has. Every option has an expiration. Every expiration has a commensurate days till expiration that exists. An option that has 30 days in it will have 30 DTE or 30 days to expiration. An option that has 60 days in it will have 60 DTE, etc. Peter, I hope that answered your question. If you need more information, send us an email at options@theocc.com. Should an option be selected if the delta is less than 50? Lonnie, good question. I can't really answer that question because the delta of an option is really just a measure of how much it should theoretically move relative to the underlying move. And so you're kind of the person that needs to answer that question based on your risk tolerance and what your view of the marketplace is. What I can tell you is that options that have more delta, that are closer to the 100 bound, are going to move more theoretically for every $1 move in the stock, and an option that has less delta, closer to the 0 bound, is going to move less in price relative to that same dollar move. So you need to make that decision as to whether or not that aligns with your risk tolerance and your preference for what you're looking for in the option that you're trading. All right. Mike says he's looking at the last slide for more information. Can we fix the slides, please? For more information, send us email questions at options@theocc.com or check us out at optionseducation.org. Those are the two pieces of information that are important there. What does the delta measure? The probability that the options will be in the money at expiration. Does that measure that too? Fair Dune, yes. Many times, and I don't think I brushed on this in the actual presentation, but many times people who trade options think about delta as the percentage chance of the option finishing in the money. It can be considered that way. That is an acceptable way to think about delta. The reason why I use delta in this way when I'm talking about the actual metaphor to think about it that way is because I want you to think about it relative to something that you understand very kind of like viscerally, intrinsically. Most everyone understands what a speedometer does for a car. And I want you to think about it in that way. It's a way for you to think about how fast this option is going to move relative to the $1 move in the underlying. And so options with high delta are going to move a lot more than options with low delta. But some people do think about option delta as a measure of the percentage chance that that option is going to finish in the money at that moment in time. So you need to think about that as well. That percentage chance can change over time as we get differing things that move the market around. And so thus the delta can also change over that period of time as a function of the market moving. Make sure you build that into your kind of mental framework as well, because it's important to think about it that way. Thanks for your question, Ferdinand. Dennis, what is the range for gamma? What is low or what is high? Dennis, this is a great question. Anytime anyone asks me a question of what is low and what is high gamma, low gamma is the low bound of gamma for an option is 0. That is an option that's not going to move, and the delta is not going to change for any $1 move in the underlying. Those are options that are going to be really far away or are about to expire, and they're really far away. The upper bound of gamma is a lot harder to talk about and consider in this way, and let me give you the reason why. As I said in the presentation, gamma in the front of the curve, as you get closer to expiration, gamma starts to increase exponentially, particularly for options that are at the money. The reason why is because gamma is a measure of an option's sensitivity to underlying movement. If you're talking about an option that is in the money, let's say it has a 100 delta, and you are 3 seconds until expiration, and then the stock drops $15, and that option, which looked like it had 100 delta because you have 3 seconds to expiration, is now out of the money because it went through the strike. Let's pretend we're dealing with an in-the-money call that immediately, right as everything expires, becomes an out-of-the-money call. What is the actual gamma of that option? And the answer to that question is pretty infinite. It's basically infinite. And so the gamma of that option at the moment of expiration is technically infinite because it went from all of the delta, 100 delta, to none of the delta, 0 delta, like that. And so gamma, asking like what is the high gamma of an option, gamma can be infinite right at the moment of expiry, especially if things are moving around. And the delta of your option changes from 100 to 0. It goes from the most delta an option can have to the least delta an option can have. And the gamma is what does that to it. So when you get close to expiration, like really close to expiration, the gamma of those options becomes infinite, and the theta of those options goes up as well, commensurately. If you need more information about that or want to discuss it further, send me an email, and we can talk about gamma as a function of time, because that's a really interesting conversation. John P., I've tried twice this year to email options at theocc.com and gotten no reply. John, I agree. That is sad. Make sure that you send it to options at theocc.com. We respond to every single email that comes into the investor education desk. I myself am one of 4 that works on that desk, and we take pride in the fact that we respond to all of those emails. So please send us another one, and I promise we will get to it when it comes in. Let's see. Oh, man, we have a lot of questions. Let's see. All right. The Greeks of an ETF are composed from the Greeks of the shares inside multiplied by the proportion of shares in it, or have the other impact of the correlation between the shares? That's a really good question, Christian. The Greeks of the ETF options. So I'm not sure if you're talking about the Greeks of the ETF itself as a function of the actual composition of the ETF. For those that are uninitiated into the ETF space, many times exchange-traded funds are ETFs which represent other things. So you can have, for instance, people will issue ETFs that give people exposure to, Chinese internet companies, and it'll be called the China Internet ETF. And it's comprised of a bunch of Chinese internet companies that are then owned by the ETF. The ETF issuer issues shares in it, and when you buy the ETF, you give them cash, they give you a share of the ETF, and then they have to hold the actual stocks to balance their books as those stocks move around. Many times there will be options listed on those ETFs. The options on the ETFs are a function of the underlying price of the ETF, Christian. They are not necessarily a breakdown of the movement in the underlyings that are the compositional parts of the ETF. So when you think about ETF options, I want you to really consider the ETF itself as like a stock that you're trading, and then the options and the optionality. The broad optionality is a function of that price without respect to the prices of the individual components. The price itself of the ETF is a makeup of the movement in all of those prices, but the options on the ETF are a function of the ETF itself, not on the actual implied volatility or the movement of the underlyings, the component pieces of the ETF. How much do market makers affect the math? Earl, that's a good question. Market makers are really liquidity providers. What that means, and I was a market maker for a long time, what that means is that I am, as a function, as a market maker, I am making prices in the options. I am telling you, if you want to sell options to me, you can sell them at this price and I will buy this many of them. Or if you want to buy options from me, and this is just in a general function, I will sell you this many of them at this price. And that is my bid and my offer and the commensurate sizes that are there, the bid size and the offer size for me. When you're looking at a market, for instance, on your brokerage firm, what you're going to see is the actual conglomerate market of all the market makers together. To think of market makers as someone who is affecting the math itself is, I think, misguided. Instead, how I want you to think about this is the market maker is actually the person who's providing liquidity. The math itself is what is creating the actual price. And then the market makers are the people who are saying, you can buy this many at this price, or you can sell this many at this price. And that's my market. And then all of the markets get put together and the national best bid offer, the NBBO, goes out as one big giant market. The math itself is not a function of the market makers. And then the price of the option is a function of supply and demand. So if someone comes in and wants to buy a bunch of options, the price is probably going to go up unless the supply of those options, the offer side, comes at the same rate that the bid comes up, right? If someone comes in to buy a bunch of options, they are bidding options. If someone comes in to sell a bunch of options, they are offering options. They are trying to sell them. And that function, that supply and demand function, is what's going to change the price of the option. The price of the option is thus going to change things like the implied volatility or the skew or different kind of ways that the optionality is measured. I hope that answers your question, Earl. Are zero DTE options always gamma plays, or are there examples of zero DTE options where one can take advantage of the other Greeks, namely Theta and Vega? James, Oliver, good question. Zero DTE options are not always gamma plays, but what I want you to think about when you think about zero DTE options, and for those, again, that are uninitiated, zero DTE options are options that are expiring that day. When you think about gamma and theta relative to time, and I've done many, many presentations on this, options that are about to expire, particularly options that are at the money, have a lot of gamma for exactly the reason that I explained earlier. Options with a lot of gamma tend to also have a lot of theta with them. What that means is that when you're dealing with zero DTE options, you're going to get options, particularly when you get close to their expiration on that day, that are going to have a lot of gamma and a lot of theta. Those options in the front of the curve, particularly in that zero DTE space, do not have a lot of vega in them. The reason why is because they are about to expire. Vega is a function of duration. Vega is a function of time. The more time you add to an option, theoretically, the more vega they have. The more vega they have, the more sensitive to implied volatility they are. When you think about zero DTE options, I want you to think about them as having a lot of gamma and a lot of theta relative to the longer term options, and the longer term options have a lot more vega and much less of the gamma and the theta that's with those zero DTE. So I hope I answered that question. There's a presentation that I did on zero DTE options last year that I've done a bazillion times. Make sure to check it out if you want. You can find it on the OIC website. Is there a way to tell if an option is overpriced? Rob Simmons, question. I can't tell you if there's a way to tell if an option is overpriced or not. Many people will have methodologies with which they will look at optionality and tell whether they think options are overpriced. One way that people do think about this is they look at how much an option price, which is associated with an implied volatility, is forecasting for movement over the course of the option. That's what the price and the implied volatility are really doing. They're telling you how much the market is forecasting for movement between now and the time the option expires. Sometimes people will take that. Let's say you're talking about a 30-day option. Sometimes people will take that as the 30-day implied volatility expectation and compare that with the previous 30 days historical or delivered volatility for the stock, how much it has moved over the last 30 days. And in a sense, when you're thinking about option trading, that's really the crux of what we're dealing with. And what I always dealt with as a market maker was I have really good data on how much this has moved over the last 30 days or 10 days or 5 days, because historical volatility is backward looking. I don't have a crystal ball that looks forward. What I do have is an implied volatility that's associated with the price, which is a measure of how much the market is telling me this thing should theoretically move over the next 5, 10, 15, 30 days, whatever the duration of that option is. But that's not as set in stone as the historical volatility is. The actual crux is like whether or not you actually get that same amount of movement over the last 30 days to continue over the next 30 days. That's where historical volatility and implied volatility differ. One looks backward, historical, one looks forward, implied. And so the way that many people think about options being overpriced or underpriced is that they compare those two things. What I'm here to tell you is that you have to make a decision as to whether or not your forecast is for the previous amount of volatility to actually continue in the future. That's going to be what needs to actually rule whether or not you think the options are overpriced or underpriced relative to that. That's the only real way that I can answer that question. I've heard traders and market makers both referenced. Are they the same? Ed, good question. Market makers theoretically are people who actually provide liquidity by making markets and options, or options market makers. In some ways, market makers are obligated to post both bid and ask prices for options, particularly if they are what are called designated primary market makers, or DPMs. I would say traders, or prop traders, as the market generally calls them, which is called proprietary traders. That means someone who is trading maybe their own money or maybe their firm's own money. Prop traders are people who generally what is called take markets. They're market takers. That means if I were here saying my market, if I'm a market maker and my market is 4 bid at 4.5, meaning I'll pay 4 for the option and I'll sell it at 4.5, and I'm 100 by 200, I'm the market maker, making the market. Now, there might be 10 other market makers out there who are also making the markets. But someone who comes in and is a market taker might look at 4 bid at 4.5 and say, I'll pay 4.5 on 1,000, and actually sweep all of those by buying all of the 4.5 offer that are there. That person is a market taker, and thus I would kind of call them more of a trader, proprietary trader, than the person who is just making markets. The idea behind market making is that you have a theoretical value in your head or on your screen, and you're making a market around that theoretical value. Generally speaking, you get to buy on the bid and sell on the offer. That is how you theoretically make your money. Edge relative to implied value, which theoretically should be in between your bid and your ask. So that's the difference between market makers and market takers or traders. I hope that answers your question, Ed. That's a good one. That's the 0DTE question again. If the price of a stock goes down, does the price of the auction go up or down if you're selling a put? Good question. Let's not talk about it if you are selling a put. Let's talk about calls and puts. Calls generally are positively correlated in price to underlying movement. Puts are generally negatively correlated in price to underlying movement. What that means in real terms is theoretically, When stocks go up, calls theoretically go up in value, and when stocks go down, puts theoretically go up in value. Calls are positively correlated. When stocks go up, calls theoretically go up. Puts are negatively correlated. When stocks go down, puts generally go up. The opposite of that is true also. When stocks go up, puts generally go down. Stocks go up, calls generally go up. When stocks go down, calls generally go down. That's the positive correlation and the negative correlation. Okay. Also a newbie here, Stephanie. When would a delta be negative, and would that be a good thing or a bad thing? Deltas of options are expressed as positive or negative if they are puts or calls. Generally, calls are expressed as positive deltas because of that positive correlation that I just said, and puts are generally expressed as negative deltas because of the negative correlation to price that I just said. However, you can buy or sell calls, which would give you a positive or a negative delta, and you can buy or sell puts, which would give you a negative or a positive delta. So it's a little bit confusing in that way, but I want you to understand first and foremost the concept of positive correlation and negative correlation to underlying price movement. Puts are positively correlated. Puts are negatively correlated and calls are positively correlated. That's why when you see a call delta, it's generally expressed as positive. When you see a put delta, it's generally expressed as negative. However, your position can be the opposite of those two things if you sell that option versus buying. Let's see. Hope that answers your question, Stephanie. Con, is it not the decay of at-the-money options accelerates only and not for the in-the-money and out-of-the-money options as time and expiration years? Good question. What Con is asking here is, does the decay of an option, if it's in the money or out of the money, accelerate toward expiration as well? The answer to that is yes, it does, but at a different rate. You're not going to notice it nearly as much. In the money options and out of the money options have decay features as well, but they are much more linear. So an in the money option only has a very small amount of its value that is decaying. The extrinsic portion of it is a small part of its value, and thus that part is going to decay over time, just like any extrinsic value will, but it's such a small part of the actually overall value of the option, you're probably not going to notice it as much as it goes exponential towards expiration. It doesn't have as much curvature to it. You're not going to notice it as much. But yes, the actual decay does kind of do this, but it does this mainly in those at the money options, which happen to be all extrinsic value. Why you notice it so much more when they're at the money. Oh, good. Ari, Vega metaphor that I asked for earlier. Blowing up a balloon that is thin-walled and large versus blowing up a balloon that is thick-walled and small. Interesting. Ari, I like it. Thank you very much. That's a great metaphor. Hopefully I'll be able to incorporate it into my Vega and Rho mathless Greeks. Okay, Carlo, I know the question is a tad off topic. What does it mean to have positive or negative gamma in the market? Can it be calculated? Yes, the answer is it can be calculated. I mean, to have positive or negative gamma yourself is very easy to calculate. It is the gamma of the option that you have times however many of those options you have either bought or sold. In the case of gamma, when you are buying options, you are buying the actual right to turn that option into some other thing, right? If you're buying a stock option, you're buying the right to actually exercise the option. And thus, the gamma that exists in that option is actually yours. You are long gamma. However, if you were to sell that option to someone else, you are selling that right and incurring the obligation then to make that contract whole, and thus you are going to be short gamma. When you're looking at it from the perspective of the entire marketplace, it's much, much harder to calculate how much gamma all of the dealers are either long or short, if that's what your question is asking, Carlo. I know a lot of people talk about it as in dealers have a lot of long gamma exposure or short gamma exposure at this particular strike because of the open interest that exists here, et cetera, et cetera. That can be a hard thing to build into your mental framework around the optionality that exists there because it's very opaque. It's hard to tell what people have against those options. They can have lots of different things against those options. I always say this. I think it's a bit of a fool's errand to try to read the tea leaves of the open interest in the market because I don't necessarily think you can understand exactly what people have against their other options. Yasmin, sorry, I missed the Delta explanation. Is your presentation available to view again somewhere? Yes. Use the same link that you used to get in here, and we'll have it posted for on-demand viewing later on. It's usually a couple of hours, but if you check back tomorrow, it should be available. Let's see what other questions we have. Man, we have a lot of questions. Let's see. Don P says, how to use Greeks when reviewing spreads. I monitor them prior to single leg trades, but with multi-legs, they seem to counter each other and the combined premium stays until expiration. So it seems like a binary trade, mainly for waiting until the end. Okay, John, the Greeks of a spread are really just the combination of the long part of the spread and the short part of the spread. And so let's say you are long a call spread and you're long the 30 calls and you're short the 40 calls. The Greeks that exist for that position are going to be the combination of your long 30 call and your short 40 call. Your long 30 call is going to give you long delta. Against that, your short 40 call is going to give you some amount of short delta. So let's say your long 30 call is a 50 delta option and your 40 call is a 20 delta option. The Greek of that spread is going to be 50 minus 20. It's going to be a 30 delta spread. The same can be true of the gamma of those options. They're going to be, right, one of them you're going to be long gamma and one of them you're going to be short gamma. And the combination of them is going to give you the gamma of your position. And the same is also true of delta and theta. The theta of one option, which is closer to at the money, is probably going to be more than the theta of the other option, which is farther out of the money. So if you are, for instance, paying 10 cents of theta on the long option that you have in that, and you're collecting 3 cents of theta on the option that you're short, the theta of the spread is going to be 7 cents. Now, those two options may decay at different rates because of how close to being at the money they are. And so the theta of that spread may change over time as you get closer and closer to expiration. But they may have different curvature to them. The different curvature might exist for their delta, their gamma, and their theta. Make sure to build that in. That's part of what you're saying when you're looking at it and seeing that like they don't decay at the same rate. It looks like they should be set up as a binary trade relative to expiration. I totally understand where you're going, but I think what you need to pay attention to is the actual rate of decay for each one of those options individually, because they might have a different rate of decay and a different delta decay as well. Okay. I'm going to take, let's see, it's 4:30. I'm going to take 2 more questions. All right. What are your thoughts on buying option trading signals? Any you would recommend? Number one, I am industry agnostic, so an industry player agnostic. We cannot recommend anyone who gives trading signals or advice to the marketplace. We're not registered investment advisors, and our whole job is to educate people as to how options work most broadly, help you to understand both the risks and the benefits of exchange-traded options. So I can't ever advocate for one person or another that especially someone who sells a service like that in the marketplace. What I can recommend is that you utilize the free education that we provide at optionseducation.org and get yourself mentally in the game as far as what you think of as to when you think options should be bought or when you think options should be sold, because someone who is educated as to how the optionality works more broadly is so much better equipped to make those decisions for themselves. All right, very last question. Okay, in the presentation example of delta, you had it at 0.08. I thought you said that the 0.08 was the amount of cents in the option it would decrease in a 24-hour period. Shouldn't it be the percent that it would decrease in cents? Okay, two things. Number one, they are both expressed as decimals. Delta and gamma are expressed as decimals, as is vega, but we didn't talk about vega today. If you see something that has a delta of 0.08, that would be expressed as 8 delta. What that means is that for every $1 move in the underlying, that option is forecasted to move as a function of the underlying move 8 cents. Why it's actually expressed as 0.08. If you see a theta of 0.08, that is a measure of how much your option model is telling you that option should decay over a 24-hour time period. That is an actual cash amount, 0.08. That means if you fast forward the clock 24 hours, that option that might be worth $3 right now is going to theoretically be worth $2.92 at this time tomorrow. Now that's if everything else stays completely constant. Does everything else ever stay completely constant? No. But we're talking about theoretical ways to look at how much this option should move. So that's why those two things get used in the presentation and how they get used in the presentation. So I think we're out of time. It's 4:36. It's past time. One thing I do want to really highlight, as always, is optionseducation.org. You can see it on the slide right here, optionseducation.org, and investor education options at the OCC.com. Make sure to take advantage of both of those resources. We host all of our educational content at optionseducation.org, and we answer email questions that come into the investor education desk at options@theocc.com on a daily basis. Please lean on us for unbiased information about options. We love to help and leverage all of our experience in trading and optionality to help educate you as to how options work. I really appreciate everyone for joining us today. This is a bit of a new kind of event that we've created. We hope that you like it. It's a little bit more interactive than our normal events. So if you have positive or negative feedback about the event itself, send us emails at options@theocc.com and let us know how you feel about it. Thank you very much for joining us today. I hope you have a great day.